Good morning, student. I continue this chapter, Basic Accounting Term for class 11th. This is my lecture number 7A. I have explained in my previous video, that is 6A, lecture number 6A, business transaction, event, account, capital, liabilities, assets, drawings, receipts, and expenditure. All these items explained in previous video. Now I am going to explain next item, which is also under the chapter Basic Accounting Term. Next thing is expenses. Expenses is the cost incurred in producing and selling the goods and services. According to Miller, expenses is the cost of use of things or services for the purpose of generating revenue. Cost of goods sold, amount paid for rent, commission, salary, advertisement, etc. are known as expenses. Now next point is income. Income is different from revenue. Amount received from sale of goods is called revenue, and the cost of goods sold is called expenses. I also explain about revenue. So, revenue is different from income. Amount received from sale of goods is called revenue, and the cost of goods sold is called expenses. Surplus revenue over expenses is called income. Surplus revenue over expenses is called income. Now, for example, suppose the goods costing 4 lakh are sold for 5 lakh. Cost is 4 lakh and sold in 5 lakh. 5 lakh will be revenue. Goods costing 4 lakh will be expenses. So, revenue minus expenses equal to income. 1 lakh therefore will be the income. Difference between two, that is revenue and expenses, are called income. It can thus be expressed as income equal to revenue minus expenses. Now next point is profit. profit. It is the excess of total revenue over total expenses of a business enterprise for an accounting period. Profit increases the investment of the owners. Now, profit is different from gain. Gain. It is monetary benefit or profit or advantage resulting from events or transactions which are incidental to business, such as sale of fixed asset, winning a court cases, or appreciation in the value of an asset. For example, if a building costing 10 lakh rupees is sold for 12 lakh rupees, 2 lakh rupees will be gain on sale of building. Because I do not deal the building in business, I have some other business, but when I sold building of business cost 10 lakh and in 12 lakh 2 lakh rupees will be gain. Now next point is loss. The term loss is the result of the business for a period when total expenses exceed the total revenue. It is just opposite of profit. So when expenses is more over revenue, then it will known as loss. Now next point is purchase. The term purchase is used only for the purchase of goods in which the business deals. In case of a manufacturing concern, goods means acquiring of raw material for the purpose of conversion into finished product and then sale. In case of trading concern, goods are those things which are purchased for resale. For example, if a cloth dealer purchases cloth for sale, the cloth so purchased will be called goods. However, if the same cloth dealer purchases furniture for seating the customers, such furniture will not be termed as goods, but it will be an assets, and a separate account named furniture account will be opened for it. The term purchase include both cash purchase and credit purchase of goods. Now next point is sale. Sales means transfer of ownership of goods or service to customer for a price. For example, if Ram sells a computer to Shyam, the ownership of computer will be transferred from Ram to Shyam, and Ram is entitled to receive the agreed price of computer from Shyam. Now, next point is stock. Stock or stock in trade. The term stock includes the value of those goods which are purchased for resale and which are lying unsold at the end of accounting period. The stock may be two types. One, opening stock, and second, closing stock. The term opening stock means the value of goods lying unsold at the beginning of each year. And whereas the term closing stock means the value of goods lying unsold at the end of the accounting period. Now, next thing is inventory. In a case of manufacturer, there can be opening and closing inventory of four types. First is inventory of raw material. Raw materials. It include inventory of raw materials purchased for using them in the product manufactured but still lying unused. For example, the value of cotton in case of cloth mills is the inventory of raw material. Second thing, work in progress. It is also termed as inventory of partly finished goods. It means goods in semi-finished form. Such goods need further processing for converting into finished goods. For the valuation of work in progress, the value of raw material used in it, the cost of labor, power, fuel, other expenses, etc. In case of cloth mill, the value of thread and the unfinished cloth will be inventory of work in progress. Third point is inventory of finished goods. It includes the inventory of those goods which have been completely processed and are ready for sale but are lying unsold at the end of accounting period. In case of cloth mill, the value of finished cloth will be the value of inventory of finished goods. Fourth point, inventory of stock in trade. It includes the value of those goods which are purchased for resale. Now, difference between stock and inventory. Stock refers only to the value of those goods which are purchased for reselling and which are lying unsold at the end of the accounting period. Whereas the inventory is a wide term which includes stock also. Thus, inventory can be measured or include raw material, work in progress, finished goods, and stock in trade. Now, next thing is trade receivable. Trade receivables. The trade receivable refers to the amount receivable on account of sale of goods or service rendered by the company in the normal course of time. Trade receivable include both first debtor and second bill receivable. Bill receivables. Trade receivable include debtors and bill receivable. Debtor represent those person or firm to whom goods have been sold or service rendered on credit. To whom goods have been sold and service rendered on credit, and payment has not received from them. They still owe some amount to the business. For example, if goods worth 50,000 have been sold to Ram on credit, he will continue to remain the debtor of the business so long as he does not make the full payment. Now, second thing is bill receivable. A bill of exchange become bill receivable for the person who draw it and gets it back after its acceptance from the drawee. Thus, bill receivable is an accounting term for bill of exchange drawn on debtor. When bill is drawn on debtor, it will make bill receivable. The amount specified in such a bill is receivable at a future date. Now, next point is trade payable. It also includes two things: creditors and bill payable. Creditors is just opposite to debtor. The term creditor represent those person or firm from whom goods have been purchased or service procured on credit and payment has not been made to them. Some money is still owing to them. For example, if goods worth 50,000 are purchased from Ram on credit, he will continue to remain the creditor of the firm so long as the full payment is not made to him. Just like bill payable is also opposite to bill receivable. Bill of exchange become bill payable for the person who accepts and return it to drawer. Thus, bill payable is an accounting term for bill of exchange accepted in favor of creditors. Now, cost. Next point is cost. Cost can be termed as the amount of resources given up in exchange for some goods or services. The resources given up are money or money's equivalent, expressed in terms of money. For example, cost of machinery will include purchase price, freight, and installation expenses, etc. Now, next point is voucher. Voucher is a document which provides the authentication to pay and on the basis of which the business transactions are first of all recorded in the books of account. A separate voucher is prepared for each transaction and it specifies the account to be debited and credited. The form of a voucher varies from firm to firm since vouchers are printed separately by different firms in their own names. Vouchers are prepared by accountant and each voucher is numbered and countersigned by the authorized person of the firm. Now, next point is discount. It is a rebate or an allowance given by the seller to buyer. It is of two types. First is trade discount. And second is cash discount. Trade discount is allowed by a seller to customer at a fixed percentage on the list or catalog price of the goods. It is called trade discount. It means trade discount is given by manufacturer to wholesaler, wholesaler to retailer, retailer to consumer, etc. For example, when we purchase a book at the rate of 10% discount, it will be known as trade discount. But cash discount is given to customer for quick payment. For example, if seller allow 2% discount for payment within a week, it will be called cash discount. It is always recorded in the books of account, but trade discount is not recorded in the books of account. Now next thing is GST. GST, full form of GST is Goods and Service Tax. Goods and Services Tax. All indirect taxes like custom duty, excise duty, sale tax, VAT means value added tax, service tax, etc. have been merged into a single tax known as GST. GST is paid at the time of purchase and GST is collected at the time of sale. GST paid at the time of purchase and GST collected at the time of sale by the businessman. Now some important accounting term is now entry. When a transaction or event is recorded in the books of account, it is called entry. Bad debts. It is the amount that has become irrecoverable from a debtor. When amount irrecoverable, then it is known as bad debt. It is the loss for business because debtor have been already insolvent. Next point is insolvent or bankrupt. Both are same territory in India, but in America both have separate meaning. Insolvent means a person or an enterprise which is not in a position to pay its debt is called insolvent. Now next thing is solvent, just opposite to insolvent. A person or enterprises which is in a position to pay its debt is called solvent. Now I have explained about revenue in previous video. Now one more thing, livestock. 27. Livestock means domestic animal such as cattle, horse are known as livestock because it is also used in a business. I will meet you in next video with some new topic. For till time, thank you very much for listening.